All right, guys, it's James. So today we're going to talk about how Donald Trump allegedly has saved money on his taxes. So what I do know is real estate developers save money on their taxes this way through strategic depreciation. What does that mean? The process is called cost segregation. So on your typical rental schedule, when you buy a building or a house, you get to depreciate that asset over a 27.5-year basis or a 39-year basis for a commercial building. What cost segregation does is that you actually hire a company, they do a study, they go through forensically break down every little piece, every little nook and cranny inside the building. Like for example, they would look at this can, they would break down the walls of the can, the cap, what's inside, and they section it out, allocate the depreciation schedule for that specific little unit, and it allows you to depreciate the building over 50% quicker, which then takes down your income and saves you money on your taxes. So what happens when the building's fully depreciated over a 13-year period instead of 27 years? What investors then do strategically is they'll set up a 1031 exchange, sell the building, and then reload into a new building, which then allows them to restart their depreciation schedule again. Again, another way to start saving money on your taxes. But don't forget to plan. You are going to have to pay this tax gain at some point in your life. So the whole point is you want to do this while your income is high. Once your income goes down, who gives a shit? You're already getting taxed at a lower bracket anyways.
So normally it's 30 years, but doing this cost segregation lowers it down to 15 years. So what are just some kind of rough example numbers? How does that look then?
Well, so typically, the depreciation schedule is actually 27.5 years on a house.
Okay.
So it's going to usually cut that down by about a 50% period.
Okay.
So if you, let's say again for that example, if it's $1 million building, you can, instead of getting a depreciation of, well, that's going to be roughly like 45 grand a year on a 27-year basis. Instead of being able to write off 45 grand a year, you're going to be able to write off 90 grand a year for that building, because you're doing it in half the time.
Got it.
So that's going to save you an additional $45,000 in taxes that year. So the general principle is to actually depreciate during high income years and then sell the building when you're actually having a low income year, because your tax bracket's a lot lower at that time.